everybody, and welcome to today's edition of the Liberty Action Network TV. I'm your host, Doreen Finkel, and today we are going to be talking about the current state of the economy, the job market, the Federal Reserve, and where we'll be in the next 4 years with another 4 years of the Obama administration. And joining me today is Dr. Murray Sabrin, professor of finance at Ramapo College of New Jersey. He's also author of the book Tax-Free 2000, The Rebirth of American Liberty. Welcome to the show.
Thank you, Doreen.
I'd like to start with the job market first. The last figures we had was that the current unemployment rate was at 7.6%. That was national. And some of the critics have mentioned that, especially with the increase in the month of March of only 88,000 jobs, that wasn't good enough. That's what the critics are saying.
Well, the preliminary report for April from ADP, which does their own survey, is that 112,000 jobs were created in the month of April, which is below the expectation of nearly 150,000 jobs. So clearly the job market is not robust by any means, and there are also troubling signs in the job market that a lot of college graduates are having a hard time finding jobs. A lot of college graduates are working jobs that they're totally overqualified for. And so we've got a situation in this country where we don't have a strong economy, and the strong economy is what we need to get out of the mess that we're in that, quite frankly, both political parties have put us in because they voted for legislation over the years that has created this gigantic federal budget of $3.8 trillion and this massive debt of $16 trillion.
So, in other words, what is our government not doing?
Well, it's not getting out of the way, basically. We need a free enterprise economy, and we don't have it. We have a mixed economy. This mixed economy has been developing for really 80 years, since the depth of the Great Depression in 1933. So it's really exactly 80 years that the federal government has been tinkering with the economy. Now, the economy has grown since then. There's a lot more wealth in the economy. The standard of living is a lot higher. But we go through these periodic spasms known as depressions, recessions, because of the Federal Reserve's manipulating of interest rates. And so what we need to do is get the Federal Reserve out of the way, let interest rates reach market levels. We need the federal government to reduce the size of its budget. We need to reduce the regulatory burden on American business. We need to reduce our military presence around the world, which is draining resources from the American people. So it's pretty simple to figure out what needs to be done. Free enterprise works, free markets work. Government can't manage the economy.
Okay, and also I want to ask you, should the government be providing incentives to small businesses to help them?
Well, the incentives are pretty clear. The incentives are lower tax rates, lower capital gains tax, get rid of the estate tax. These are things that hinder job creation, hinder capital formation. And so if the government got out of the way, it would free up resources that people could use in confidence that the government's not going to switch gears 2, 3, 5 years down the road and raise taxes on them. One of the problems we have in our economy is that business people, when they're planning a long-term project, what rate of taxation do they plug into their calculation to determine what their net profits will be 3, 5, 10 years down the road? What will their health costs be down the road? Because with this Obamacare, we're going to see an increase in health care costs, according to the latest reports that are coming out, that insurance companies are raising rates because of the impact of Obamacare on the health insurance market.
And also, how does the Obamacare affect the employers, in other words, from hiring and?
Well, if you have more than 50 employees, you have to provide health care. If you don't, you have to pay a tax. And so what employers may do is to pay the tax and reduce their health care costs and tell employees, you have to go find your own health care. And the problem is, the reason we have health care tied to to employment is because of World War II, when we had wage price controls and employers offered an incentive to hire, to get people to work for them by offering medical insurance, which of course was not the appropriate way to do things, because we pay for our own life insurance, we pay for our own automobile insurance, we pay for our own property and casualty insurance. We don't need the employer to do that for us. And so here's another example of a government intervention in the economy that has these long-term effects, these unintended consequences, which are going to wreak havoc in the healthcare market, havoc in the ability of people to get affordable health insurance. And so, again, the evidence is overwhelming that if we free up the economy, free up the health insurance market, prices will come down, premiums will come down, and we just need to get the government to realize that. Unfortunately, their philosophy in Washington is that they can run our lives. They can manage our lives. They can control our lives. They can tax away a good portion of our income. They can control our property. And this is what's hurting the U.S. economy.
And you had mentioned about the employers paying the penalty, which I believe is about $2,000.
Right.
Okay. So the employer's going to say, well, I'd rather pay the penalty because it's cheaper.
Absolutely. Absolutely.
From a business perspective. And now looking from that point of view, if one company starts that, there might be a fever around the nation.
Well, this is what I think the concern is of people who are looking at this very carefully. I'm not a healthcare expert. I've just been reading a lot of the reports that have been coming down the pike over the last few years, and the evidence that people have come up with is that employers are going to say to themselves, why should I keep on providing health care at a cost of $10,000, $15,000 per employee when I just have to pay a $2,000 penalty and tell the employees you're on your own, maybe give them $3,000, $5,000 in extra pay, and therefore they can go shop around for their own health insurance. Again, this is why we need to get government out of the economy as much as possible, because there's no evidence that government intervention creates good outcomes. It hasn't worked under full communist societies, it hasn't worked in fascist economies, and it's certainly not happening in our mixed economy. And so the powers that be have to realize that if you free up the economy, you'll be a hero. And they think that the only way to create a better economy is if they intervene continuously.
And also, I want to mention the fact that what is the incentive then of an employer to attract a good employee? Would it be to offer the health insurance? Is that to the employee?
No, I think what employers will have to do is to offer them higher wages in order to make sure that they get the best talent for their business. And now you're seeing that in various industries, like the high-tech industry. Some of those jobs are very good paying jobs for young people, starting at 60, 70, 80, 100,000, depending on their skill set. There was just a report the other day of all the jobs that are in great demand: actuaries, financial planners, physical therapists, hygienists, things that require skills. And if you have that skill set, this is an economy that is good for you, because employers are looking for good people who have skills that are going to add value to the business, that's going to attract customers. And the same thing with young people are now very entrepreneurial. They want to be their own boss, and that's why you're seeing a lot of activity on the internet. People are creating these new platforms. That's the exciting part of the economy that we're in. And you have these young people doing incredible things in healthcare as well, discovering things that even the experts weren't able to discover. So there's a lot of excitement in the economy, but there's also a lot of drag because the federal government is so heavily involved.
Right, and there's also the uncertainty of what's in Obamacare that the businesses don't know.
Well, I think they know a lot more than they did a few years ago, and what that means is it's going to be very difficult to run a small business. And if you have 25, 30, 45 employees and you're growing, and you may not want to reach that 50 plateau, because once you hit 50 employees, that's when all these rules and regs kick in. And so this puts a damper on people's plans for expansion. So again, people's behavior is pretty predictable once you have adverse rules and regulations that will go into effect, because if we knew that taxes were going to go up next year, what would people do? They would spend a lot of money today, because if they earn money next year and taxes are up, they're going to have less money to spend next year. So you would create a big demand for goods today. Well, the same thing would happen with healthcare. If their costs go up, they're going to say, well, I'm just going to not deal with it. And so that's why it's pretty easy to figure out when you have adverse incentives in place, you're going to get bad outcomes.
And I wonder, when they hit that 50th employee plateau, they may say, oh, well, we want to hire more part-timers.
Well, that's the other thing is that we're reading about, is that companies are now going more toward part-time. They're hiring temps from these agencies, and this causes less productivity, because full-time employees tend to be more productive than part-time employees who don't have any benefits. And so, again, here's another example of the government rules causing distortions in the economy, in the employment situation, and also in the ability of businesses to grow. And again, we need to get the government out of sectors of the economy that they've been in for decades, and we've seen the result of massive distortions wherever we look at government involvement.
Now, how does this, or does this affect the federal deficit?
Well, the deficit has been building for decades. The deficit is a result of President Bush's desire to invade Afghanistan and Iraq when there was no clear and present danger. I think that's the key operative term. There was no clear and present danger. And so he borrowed literally $4 trillion to fight these wars, rather than going to the American people and saying, hey, we think there's a threat, we're going to have to tax you in order to make sure that you're safe. I don't know if the American people would have bought into that, because now we know, and we knew years ago, that there were no weapons of mass destruction in Iraq that were threatening us. I mean, he may have had some things that were not very good for his neighbors, but that wasn't a concern of ours. Clearly, we want peace everywhere in the world, because peace, you get commerce, commerce, you get prosperity, prosperity, you get higher living standards. So when the government officials say there's an imminent threat to us from a country that is one of the poorest on earth, except for the oil that they have, that's a disingenuous argument to make the American people. So the deficit has been building for decades because of war, entitlement programs, Medicare, Medicaid, Social Security, farm subsidies, corporate welfare. All these programs cost money, and if the government doesn't pay for them through taxation, then they're going to borrow money, and that's what they've been borrowing for the last 6 years. They've been borrowing, what, $8 trillion the last 6 years, and look at the outcome. Unemployment, according to some calculations, are as high as 16 to 20% because of all these discouraged workers and all the workers that are working part-time who would like to work full-time. So again, it's the welfare warfare state that's got us to this place in time in 2013. Massive spending, massive manipulation of interest rates, and try to create good outcomes, and the result has been, according to Professor Kotlikov in Boston, $220 trillion of unfunded liabilities. That means that's how much money we need today to pay for all the benefits of Social Security, Medicare over the next 75 years. Money the government clearly doesn't have, because it's what, more than 10 times the GDP of the United States.
Wow, I'm just taking in all these numbers.
Well, it's really frightening, because whenever a nation goes on a spending binge like we have, and you don't pay for it, you're going to create the potential for massive inflation, because the Fed has been helping the federal government by buying up all this debt the last few years. That means they've been creating money out of thin air to buy the Treasury bonds. And so this could have consequences down the road where we may see prices jump dramatically, much more so than we've ever seen in our history.
And I can tell you, I've seen the prices jump at the supermarket.
Well, this is what companies are doing. Rather than raise prices, my wife has noticed this also. Companies are downsizing their containers. So instead of having 16 containers of a product at, let's say, $5, you now have 14 ounces at $5. So that's a big jump in prices.
I've noticed that also. We're getting less for our money.
Absolutely. That's what inflation is all about.
Thing, well, gas too. I've noticed the price of gas go up also.
Well, it's been going up and down. It's been jumping around. Right now, I just filled up with gasoline at the lowest price, I think, in months, which is good, because gasoline is something that is obvious to the average American, because they're buying it usually on a weekly basis. But the main thing is taxes are going up. Property taxes are still going up. Social Security taxes went back up. Some upper income Americans are paying higher tax rates because of the so-called budget deal that took place last year. So taxes are a big portion of people's income, and that's been going away through the federal and state and local taxes. So we have a situation where the government is a big expense for the American people, and the question we have to ask ourselves, what are we getting for all these taxes? And I think the answer is not much.
That's right, and we're living less, not like our parents have. They were able to afford more for what they made.
Well, the good news is that we have a lot of things that our parents didn't have. We have cell phones. We have these great little cameras that are videotaping us today that are incredibly high quality. We have much better food, clothing, a lot better medical care in many instances where we're able to diagnose illnesses pretty easily. But things are very expensive today. I mean, the cost of sending a kid to college today is very expensive for the average family compared to when I was growing up in the 1950s and 60s. And so things have gotten a lot more expensive. And so the theme of the documentary that I'm working on with my students is whatever happened to penny candy, what happened to the nickel hot dog, what happened to the 3-cent stamp. All these things are pretty standard items that have gone up in price tremendously because of the constant money printing by the Federal Reserve.
And I noticed the price of a new car.
Well, that has gone through the roof, but we have a lot better cars today. We have things that we didn't even dream about 20, 30 years ago. GPS, we have airbags, even though they're mandated. Companies probably still would have put them in anyway. We have much better steering. We have all sorts of better radios and what have you. So cars, if you look at cars over the long term, they're probably as affordable as they were when I was a youngster. You know why? Because the way you look at things is, how long does it take you to work to buy a car? For example, my first car cost me 50% of my annual income. Today, if I were to buy a new car, it would probably be about 25% of my income. So, or 30%, whatever the case may be, depending on how much I want to spend on a car. So in many ways, car prices, even though they're high, relative to our income, we've done fairly well with that because the car companies have been pretty productive over the last 20, 30 years.
And how about the rising cost in real estate?
Well, that's an example of Fed money printing because the report just came out the other day. Housing prices are up nearly 10% from a year ago. That's total monetary printing that lifts the price of asset values. What about the $150 million painting, Picasso painting that recently sold at auction? Who in their right mind pays $150 million for a painting? That's an enormous amount of money. You could buy tremendous businesses for $150. That $150 million is not going to give you any cash flow, but you could buy a great business for $150 million and probably earn 10, 15%, 5%, whatever it is on your investment and have a nice cash flow. So this shows you that people are unloading their dollars into real assets because they're worried about the value of the dollar.
So let's just imagine for a minute, you're a student, you're going to college, okay, you're getting a career, okay, and now you have to apply for your first job, wherever it is.
Mm-hmm.
That's going to be difficult enough in this economy.
Sure.
And then this student then has to go on and establish themselves, and who knows, down the road maybe they want to buy a new house and start their own life.
Right.
This student's going to need a lot of cash.
Well, and a lot of students, some students are leaving college with a lot of student debt, which was unheard of 20, 30, 40 years ago. And so it's very difficult for a young person today to really get established unless they don't have any debt, unless they have a real good job and they can then save their money for a down payment of a house or a condo. Or one strategy to do is rent for as long as you can until you feel that you really need to have a house. But the apartment rental market has been doing very well because a lot of people are mobile. They don't want to stay in one place for a long time. And with interest rates being so low, that's one benefit of the time that we're in. You can get a mortgage probably for, what, 3.25%, 3.5%, which is unheard of. It's the lowest in my lifetime that we've seen mortgage rates. So that's one good piece of news for young people that are looking to buy a house. But the cost of everything is really high. I mean, just go to the supermarket, go to a restaurant, go to the department store. That's why people have to be very frugal and careful with their income.
Yes, and you had mentioned the student debt. I see that as being another bubble.
That's what people are arguing, that this is a bubble that if it breaks somewhere down the road, because it's $1 trillion. And again, this morning I was watching one of the financial news shows, and one very prominent billionaire in America said he thinks the stock market's a bubble. I was surprised to hear him say that because he's been very successful for decades, and now he's saying this Fed money printing has given rise to this bubble in the stock market. And as long as the market goes up, people are very content, but we may see a bigger bubble burst down the road that we saw in 2007 and 2008, according to some people. I'm not that smart enough to know exactly when this is going to happen and how deep the next bubble burst will be, but All the indications are that once you inflate the money supply, which has been happening the last 5 years, you raise asset prices, and bonds and stocks have been going up, and real estate's going up, and one day they will, their price will fall as well.
I'm just thinking and taking all this in as you're saying this. When that bubble happens, which I believe it's going to happen, will there be another ripple effect through the entire economy? Yeah.
Well, it's hard to know exactly how the bubble burst and what will be the impact, but we saw what happened the last bubble, which is not that long ago, is that the banks got into trouble, real estate companies got into trouble, construction companies got into trouble. And so you have this ripple effect throughout the economy. And so if you have another stock market decline of 50%, which is what we had the last time around, that's going to really affect people's net worth, because their 401k will go down in value, their IRA account will go down in value, and that will make them feel poorer, and therefore that may have a huge impact on their spending, which then has a ripple effect in the marketplace as people draw back on their spending plans. So what we need to do is restructure the economy, which will involve some short-term pain, but will be beneficial for the long term, because that will create a sustainable environment for future prosperity.
And you mentioned the printing of money, and what comes to mind, of course, is the Federal Reserve.
Right.
And they have this program that's called quantitative easing. Do you know anything about that?
Yeah, it's very simple. They've been printing money. The way they do it is a very sophisticated way. The Federal Reserve buys government bonds and mortgage-backed securities, and that becomes, and the people who sell that to the Federal Reserve take those checks and deposit them into their checking account at commercial banks, and so the reserves go up at the banks. The banks have now more money to lend, but they've been sitting on that money as reserves at the Federal Reserve rather than lending it out. So if they loaned all that money out, prices would go up, because this money would ripple through the economy, bidding up the prices of goods and services. So in one way, the Federal Reserve has the best of both worlds. They depress interest rates, which tries to stimulate the economy. The banks don't lend out as much as they otherwise would, which dampens inflationary fires in the economy. And so it looks like the Fed is doing the right thing, but the Fed is not doing the right thing, because most people on Wall Street, on these financial news shows, think the Fed is doing a great job because interest rates are low. But they're low because the Fed is manipulating them low. They're not free market interest rates. If we had free market interest rates, rates would be around 4% instead of 0 on the short end. And they'd be a little bit higher maybe on the long end. But this doesn't end well. Through the last 100 years of the Federal Reserve, since it was established in 1913, we've had bubbles. We had the bubbles in the 20s with real estate and the stock market. We had bubbles in the 60s and 70s. We had bubbles in the 80s and 90s, and the bubbles in the 2000s. So we constantly have bubbles because the Fed tries to stimulate the economy through quantitative easing, which is just a fancy name of saying they're creating money out of thin air. If we create money, we go to jail. They create money, they're considered heroes.
Right, and I was reading that they want to continue this throughout 2013.
Well, they said that. They've been on record saying they're going to continue to do this. In fact, they said they're going to do it probably through 2014, because they're really locked in a box, because the expectation is rates are going to stay low. The only way you can keep rates low is you constantly keep on printing new and more money, and that's exactly what they're doing. And so what they're doing is they're inflating the bubble as time goes on. So the bigger the bubble is inflated, the bigger the bust will occur somewhere down the road.
So what they believe is that through inflation, we can inflate our way out of this economic problem.
Yeah, they think that inflation is a stimulative for the economy. Sure, you can stimulate the economy, just as you can stimulate an athlete by giving him steroids or some drug that will make him perform better, which is not a natural way of performing. So this is what they're doing to the economy. We have essentially a steroid economy. They pump everything up like a muscle man at one of these competitions, and eventually, if you don't give the muscle man enough steroids, the muscle doesn't stay at muscle. So they're doing the same thing to the economy. They're keeping prices up in in different markets, the financial markets, the real estate market, and other markets, and this appears to have a stimulative effect of a lot of new activity taking place in the economy, but it's not sustainable. That's really the key point. It's not sustainable.
So somewhere along the way, we're going to just
Well, what's happened historically is the Fed starts raising rates because they're fear of inflation accelerating. That's what happened a few years ago. That's what happened in the dot-com bubble. That's what happened in the late 80s. And we had the S&L crisis because that was in a bubble in real estate in the 80s. And in the 90s, we had the dot-com bubble. So we keep on having these bubbles. And what that tells me is the people in Washington are very, very ignorant, and they don't learn from the past. And the other thing is they really know what's going on, and they hope to have their friends benefit from this with all this cheap money, and therefore they do the bidding of the people who are huge beneficiaries of all these bubbles.
But everything you're saying to me, then I look at the younger generation and I feel sorry for them.
Well, it's true because things are fairly bleak given where we are in our economic history, because the federal government has created so many expectations that they're going to take care of the old people through Medicare and Social Security, take care of the poor people with Medicaid, take care of the farmers with all the support programs, take care of this group, that group, and the other group. That takes a lot of money to do so, and if you don't have the money from taxation, and if you did have the money from taxation, you'd make the private sector poorer and you'd have a weak economy. So you're borrowing money and printing up money, and what that means is you're creating bubbles. And so young people are really between the proverbial rock and hard place. It's difficult finding a job that meets your skill set because of the downsizing of American business. And then you have all these future expenditures that the federal government will have to make to support the welfare warfare state. And that means either higher taxes, or for the young people, it would mean less benefits from the federal government. So my proposal is to let's cut taxes immediately so young people can start saving, and the federal government can tell young people, you're responsible for your own health care when you get older, you're responsible for your retirement benefits, so you don't have to pay Social Security taxes, Medicare taxes, and you are responsible, and therefore you should be saving for the future.
And it's funny you mention that because I have two children, and from the moment of their birth, my husband and I started saving for their future.
Mm-hmm.
We did not see these bubbles come along the way, so we're trying to adjust our teaching strategy to our children, and we're telling them that you have to now plan for certain things, because who knows if you're going to be able to get a job right away.
Mm-hmm.
And so we're restructuring our education to them. But there's so many in this predicament.
Well, that's why financial literacy is a very important component of a young person's education today. It should be a mandatory course, I think, at the college level, because there are a lot of young people who don't take business courses, who are clueless about where the economy is, who are clueless about investing, and think that everything is hunky-dory because they may have a nice job somewhere or while they're going to school, and I think that they can keep on spending. But you've got to be pretty conservative financially in terms of how much money you bring in and how much money you spend, because if things get out of control and you have your credit card debt get out of control, it's a tough thing leaving college with a lot of debt because you've overspent while you were making money. So people have to learn all these basic principles that I sort of learned on my own when I was a youngster, and therefore I've never had much debt through my adult years.
Right. And I'm just thinking about my own two children, and we have college coming up, and it's a big concern of ours. And we've been saving for it, yes, but it's never enough.
Well, the thing is, you want your kids hopefully to get a scholarship because they have.
That's it.
You want them to study hard in high school so they can get that scholarship, or at least a partial scholarship, so it reduce your costs as a parent.
Right. Thank you very much, Dr. Sabrin, for coming on our show, and you're welcome anytime. And to our listeners, please go to campusteaparties.com. That's campusteaparties.com for more information. And until next week.